Welcome to the Financial Literacy Academy and the Rules of Money. Video number 3 covers how to never pay taxes on your investment returns. The 3 most powerful threats your investment face were inflation, market risk, and taxation. In video number 1, we covered inflation. Video number 2, we covered how to never lose money in the stock market. Now let's talk about taxes. There's 3 ways to register your investment with the IRS. The first way is taxable. These would cover vehicles like bank CDs, savings accounts, mutual funds, stocks. The pro for that is that it's liquid. You can have access at any time. The con, of course, is that you pay your taxes every year as you go. Not a good way to get money to grow for your retirement. So most people have opted to go the tax-deferred route. These are your 401ks, your IRAs, 403bs, annuities. The pro, of course, is tax deduction. But here you have to pay your taxes later on the money you've accumulated. Let's take a closer look at these. These tax-qualified accounts work in this fashion. You put your money in, and you get a tax deduction in the current year. Instant gratification, so it feels really good. However, that money goes in and compounds and grows over time. And when you're ready for retirement, you're going to take that money out, at which time you will pay your income taxes. But there's some rules we have to follow. One is your 59.5 rule. If you try to take money out prior to 59.5, you will have to pay your state and federal taxes. For most folks, it's anywhere between 31 to 40%, depending on the state you live in. 28% federal, 8% state is pretty standard in the state of California. There's a 10% federal penalty for early withdrawal, and in the state of California, a 2.5% state penalty. That means we're giving up anywhere between 45 to 50% of our money if we need the money prior to that age. There's also a 70.5 age rule. It's called required minimum distributions. If you don't start taking out money at a predetermined rate by the IRS, they impose a 50% penalty on the money you should have taken out but didn't. If you do everything right, all you're going to do is have to deal with income taxes. And here's the question you have to ask yourself. Do you believe taxes will be less or more in the future? If you're like most people, then you probably said more. So when you look at this scenario in these qualified plans, they've set it up so if you take it out prior to 59.5, they get about half. If you leave it in too long, they get exactly half. And if you take it out on time, there's a good possibility that it'll be more. So does it make sense to leave money in a qualified plan, or is there a better way? What if there was a way we can be tax exempt? We can have our money grow, and at the end, we don't pay on any of the growth that we've accumulated. These are vehicles like Roth 401ks, Roth IRAs, and certain life insurance contracts. The pros here, simply, no taxes on all the money you accumulate over your lifetime. Let's take a closer look at Roth 401k and Roth IRA. The way they work is you give up your deduction in the current year, but you don't have to pay your taxes later, and you don't have to deal with your 70.5 rule because the IRS doesn't care when you take it out if they're not going to get any of it anyway. But you still can't take the money out until 59.5, so it limits what you can use this for. The Index Universal Life, however, works very differently. As a life insurance contract, it's like a bucket of money, and we put an electric fence around it, the electric fence being the life insurance. It follows by life insurance guidelines and life insurance rules. You put money in systematically, whether it's monthly, quarterly, annually, lump sums, and of course over time, that money is going to grow in one of those indexed accounts. Eventually, you're going to want the money out, and the only way to take this money out income tax free is to use what life insurance contracts call a loan provision. Now, if I say the word loan, you're probably thinking a couple of questions. One is, what is the percentage I have to pay, and what are the terms? Do I have to pay the loan back? In the first 10 years of the life insurance contract, in most IULs, you'll pay 0.75% for a loan. After the 11th year, till the day you die, it drops down to a 0% net loan cost. Let me say that one more time. First 10 years of the contract. So if you're 40 years of age and you get one of these, from 40 to 50 years of age, 0.75% to borrow money out of this. And from the 11th year on, 0. The reason we use a loan is because loans are not income taxable. And do you have to pay the loan back? If you do, it goes back into the account and continues to grow. If you don't, no, you don't have to pay it back. They'll just subtract it at the time of death. So you get to use it income tax-free while you're living, and the rest of it goes to your heirs income tax-free. So what would an individual or a family use this for? The general benefits of an IUL are simple. It's going to protect against certain things. The possibility of early death, the possibility of an illness, and of course, future taxes. The second thing it's going to allow you to do is use it as an emergency fund. Because there is no 59.5 rule, you can have access to it at any time. You can also use it for kids' college fund. The fourth thing you will use it for is a tax-free retirement supplement. And when both husband and wife have passed on, it could be used as an estate planning tool to pay any estate taxes that may be due. Additionally, in the last 2 to 3 years, they've added some other benefits called living benefits. What the insurance companies realized is that most people will get sick before they die. So they created certain living benefits and they put them in the policies at no extra cost. There's a terminal illness living benefit, and that's in case you have something that you know is terminal. You can use the insurance money before you die. The second living benefit is called chronic illness benefit. When you are unable to perform 2 of the 6 activities of daily living, like bathing, continence, cooking for yourself, transferring, when you can't do 2 of the 6, then it kicks in as a long-term care policy, and you can use the insurance money to live on, pay your bills, and have somebody help you. The third living benefit is a critical illness or critical injury benefit. If you get ALS, cancer, stroke, heart attack, blindness, sudden cardiac arrest, heart valve replacement, major organ transplant, cystic fibrosis, or if you go into a coma or paralysis, severe burns, traumatic brain injury, any of those things occur, you can use the insurance to live on and pay your bills while you're living. This makes this type of product very valuable as we're going through life. The wealthy have used it as a tax shelter, but you can clearly see that it's far more than that. It's an insurance policy, it's an investment vehicle, it's a long-term care product, it's a disability product. It can be whatever we need it to be as we're going through life. When it's properly structured and properly funded, an IUL is an amazing vehicle. When we look at a comparison between the IUL and the 401k, it's easy to see how one would be better than the other. There's a tax-free death benefit in the IUL. There is certainly not one in the 401k. There is no life insurance with a 401k. Second thing is, there's tax-free withdrawals and loans at any time with the IUL. There certainly is not with a 401k. You have access with no penalties prior to 59.5 in an IUL, not in a 401k. The IUL guarantees 0% loss against market risk. In a 401k, you're subject to whatever the market gives. The costs are fully disclosed in an IUL, not in a 401k. They don't have to legally disclose everything that they charge you in a 401k. There's tax-free access to insurance in case of illness. With the living benefits in an IUL, there's no such thing in a 401k. And the account value is tax-free to the heirs upon death. 401k, if you don't pay the taxes, your heirs will. The only thing we give up in an IUL is a tax deduction. So with all that in mind, is this product the right product for you? Are these tax-free strategies right for you? Roth 401k, Roth IRA, IUL. Well, how do you know? You got to ask yourself these questions. Am I saving enough for retirement? What is the number I need to retire? What about, is my plan taking full advantage of the tax-free strategies available to me? I would bet you if you're like most Americans, this is probably the first time you've heard of things like indexed universal life. So you're probably not taking full advantage of what the IRS allows. And what about, are my assets positioned in a vehicle to protect me against the next downturn in the market? So if you can't answer all three questions with certainty, then we encourage you to take advantage of the free analysis to determine whether your personal financial plan is as efficient as possible. And you'll find this button, I want my free financial analysis, on this website, teachmetherules.com. So take full advantage, and as always, all the content on teachmetherules.com, all the advice, all the analysis is at absolutely no cost. All we ask in return is that you continue to share this information with people that you feel would benefit from it. This concludes video 3 of The Rules of Money. Thank you for watching.